Most of the time, investors talk about being in a bull market or being in a bear market. They do so as a way to talk about the big trend in value. So, are things moving in an upward direction or are things moving in a downward direction? But that is not the only way. Another question you can ask about the current market regime is, are we in an orderly or a disorderly market? And the way you might go about gauging that is by looking at volatility. And the volatility data I'm about to show you goes a long way to suggesting whether there are new lows coming for Bitcoin and the stock market. And I want to unpack this data in today's video and show you the reason why the lows may not be in yet and how we should best be preparing ourselves. Let's get straight into the video. So many of you haven't experienced like the full force of a great recession, like what happened in 2008. I personally didn't have the experience of the 2008 recession just because I was a little bit too young. I'm only 22 years old. But what I do remember at the time is obviously my parents struggling. I've heard a lot of stories from other people, other families of the great struggle at that time, usually to find jobs, the housing market, there was a lot of unemployment happening and things were very difficult. But in my lifetime, this is the worst I've seen it from an investment standpoint. This market, this current situation is the closest I've ever experienced to being in a recession. And although technically in many definitions we aren't in an official recession, things are looking very grim. And that's off the back of the Fed's most aggressive rate hike sequence since the 1970s. What they are essentially doing is hiking rates in order to fight inflation. And when they do so, they create a little bit of an issue because they essentially stunt growth in many ways. Because if interest rates are higher, company valuations go down as their expenses tend to increase and the market reacts accordingly. With crypto being so similar and so tied to equities, so tied to stocks, we do see these markets move in tandem with each other. So if the stock market has a huge crash, then obviously we're going to see that reflect in crypto. There's a great article which just came out, this report by Econometrics or Ecoinmetrics, and this shows the relative decline in assets in 2022. So we can see in Bitcoin, the price has declined roughly 60%. Ethereum, obviously being more of a risk asset in the crypto market, has declined 65%. The euro has had a massive decline versus the US dollar as the Fed continues to hike rates and other currencies lose their value relative to US dollars. The Great British Pound also down 20%. So we can see most assets have taken a hit. And we all know this is how this is going to end. As it said here, the Federal Reserve will stop when the main concern shifts from inflation to unemployment. Right now, they have a license to hike rates because they are currently trying to get inflation down, but the employment numbers and the job numbers still looks all right. And the stock market hasn't really gone down enough to cause mass panic. So, so far, the job market being so robust, it means the Fed will continue to tighten. And the reason they can do that is because while stocks and bonds are down, the markets haven't turned into a complete mess. And we'll see this in the volatility metrics in a second. It hasn't turned into a complete mess relative to other declines that we've seen in the past. So nothing is completely broken. We haven't entered the disorderly phase of the meltdown. So we want to quantify this data, but via looking at the volatility metrics. And we can see the realized volatility relative to other declines over the past 20 years. So the 60-40 portfolio of stocks and bonds is a very famous portfolio. And this is one way that we can measure volatility. So if we look at this graphic here, we can see that these red dots are the current volatile orderly regime. We can see that during other major events, so the 2008 financial crisis highlighted by the yellow, the COVID crash highlighted by the green, this is the disorderly regime. Now, the disorderly regime is when volatility significantly increases. So we can see those events cause major events of volatility. Right now, we are still close to a normal regime. So we are technically not in a disorderly regime when it comes to the volatility index. So in the disorderly regime, you can find the extreme events that unfolded. So the financial crisis, the COVID crash, but this year so far, which is the dots in the red, has been relatively stable. And we are still in the orderly regime. So although the 60-40 portfolio is hurting, it's doing so in an orderly fashion. But what about other markets? We can look at how many other markets have responded to these price declines. The USD to the Japanese dollar is still relatively not very volatile. Tesla stocks, although that is a risk asset like crypto, that has been volatile, but not crazily volatile, as we can see indicated by the red for the current period. This is relative to the other crashes that we've seen. Basically, every asset has not entered the disorderly phase of the market regime. So although bonds and stocks have been in the orderly regime, we haven't seen that transition to the disorderly phase yet. So although some currencies like the British pound or the yen, even gold to an extent, are starting to move across, we haven't really seen that happen yet. Now, interestingly, cryptocurrencies have not spent much time in this category. You could probably argue Bitcoin has a wider than normal range, but if you compare Bitcoin to Ethereum or Tesla, you'll see that paradoxically, those two assets haven't been that volatile. So by any measure, they have not moved to the disorderly phase. So what can we conclude from that? Well, disorderly regimes always start with periods of volatility and are orderly markets until something breaks. So right now we're still in the phase where something, judging by this metric, hasn't broken. So this is probably a sign and probably an indicator that we are one step away from that happening and one policy mistake away from a meltdown. So the worst, although it's not guaranteed, I definitely think there is a sign of caution here that things can get worse because we still haven't entered the phase of real capitulation if we take volatility into account. And this statistic and these data to do with volatility definitely makes me question whether there are new lows to come. And I think the general consensus is that there are, but it's kind of scary just how far we are away from these other levels that we've seen in the past, despite the macroeconomic environment being very, very shaky. So I want to transfer this volatility data across to some of the data of the actual number of drawdowns. So we can see this is the mapped drawdowns, the size and duration of Bitcoin, Ethereum versus the S&P 500, which is the US stock index. We can see that currently the US stock index, the S&P 500, which is in the blue here, is right here. Now, if we look at other major crashes, the Great Recession, the dot-com bubble, the crash of 1973, the Nixon recession, we are still very, very far away from those levels, only being down 25% from all-time highs in the stock market. This indicates to me that there is a ways to go in terms of how the stock market can correct. Now, we do know that Bitcoin and Ethereum as an extension and the altcoins as an extension of Bitcoin, we know those altcoins and Bitcoin trade on a higher volatility basis to the stock market, meaning if the stock market had a major drawdown, we know these risk assets will be hit even harder because what tends to happen is the safer assets move less and the riskier assets go down more and more and more. So if the stock market did have a more significant drawdown, because right now it hasn't really come down as much as it could in theory, then I guess we could only conclude that Bitcoin and Ethereum would drop even more. And we can see, according to the orange dot here and the pink dot here for Bitcoin and Ethereum, we're still a little bit of a ways off from the lows of the 2018 bear market in terms of net drawdown in percentage terms. So in percentage terms, Ethereum still has another 40% to go on the way down, and Bitcoin still has another 30 to 40% to go on the way down. If we look at the size of the drawdowns, because we still aren't quite there, we are getting closer. And cryptocurrencies have certainly moved faster than equities because to some extent they do front run those markets, but the drawdowns are not as severe as they technically could be according to last bear markets. And this is the data point that really worries me. It's that if we get a stock market drawdown, how do crypto assets actually get hit? Because we can see right now, according to this red line, this is where we currently are in the scheme of other major drawdowns. So the 2020 crash, the 1973 crash, the 2008 financial crisis, and the 2001 dot-com bubble, we are currently in the red, and we still haven't come down near, even close to a lot of those targets in terms of percentage drawdown. I mean, we're only down 25%. That is the worrying thing, that if the Fed keeps hiking rates, the stock market takes a hit, then obviously we see risk assets declining even more. And the thing is, the Fed can keep hiking rates until something breaks, or they can get until the point close to if something breaks. So it's going to be interesting to see how this actually pans out. And just to put this bear market into perspective versus other bear markets, we can see that the current bear market is quite small. So this column on the right is the current bear market, drawdown of 20%. This is another way to visualize it. These are the previous drawdowns from 1970, the global financial crisis in 2000. Now, one would argue potentially the current macro environment is not as bad as the environments in the past. And that is a valid argument. However, we are seeing a very unique situation at the moment where inflation isn't coming down. They continue to hike rates, and we're seeing the collapse of many global currencies across the world relative to the US dollar. And this strength of the US dollar is starting to really put a damper on asset classes. And this is something that has become a major concern. And we can see this because if we look at the top 20 largest peak to trough drawdowns for the S&P 500, going back to 1961, never in history in an extreme drawdown of stocks have treasuries, which are considered the risk off asset, gone down more than stocks. So we can see this purple line here, which is treasury bonds, US treasury bonds, considered a very safe form of asset. This asset class has declined now more than stocks, which is absolutely crazy that we've seen the performance of treasury bonds be even worse. So this does signal a little bit of a shift in the macroeconomic environment, and that is something else to be worried about. By the way, it's not all doom and gloom. I'm going to get into how to prepare in a second, but I'm just giving you the factual data now to actually look where we sit, because of a lot of us lose perspective. And right now, crypto is so macro dominated. We do have to look at the stock market in order to verify where we are headed as a crypto market. I don't mean to scare anyone. I'm just giving you the data. I'm being real with you. And then in the end, I'll get into my thesis. We can also see that this year, although the drawdown hasn't been that big, the number of days experiencing negative price movement is actually the highest it's been since 2002. So we are going down in many days throughout the year, but those percentages aren't quite as big as they were in the past. And if we compare the Bitcoin bear market specifically to the previous bear market, we are now almost there in terms of the market length and the length of the previous bear market. My one caveat to this, though, would be this previous bear market happened in a quantitative easing environment. So monetary policy was very favorable with money printing. They weren't actually contracting the monetary supply. We are in a very different situation now, which is why I think charts like this are actually kind of irrelevant. And that's why the stock to flow models are relevant. And that's why most pricing data is irrelevant based on historical Bitcoin and crypto events, because the environment we're in now is tightening, and it's very, very different from taking data from an easing environment. So what is happening in the near future? Will this volatility continue, and will we see this major decline in the stock market? Well, over the next few months in quarter four, we do have to take our attention to some of these major economic events. Now, we do have a lot happening throughout the rest of the year. It honestly is quite scary because the Fed did indicate they want to keep hiking rates into mid-2023, according to the latest dot plot, where 12 out of 19 experts agreed that they are going to hike rates to around 5% cash rate. And we can see that in the meantime, on their path to doing this, there is many major events. We have the US CPI, the many FOMC minutes, Powell continues to speak, and right now, honestly, the market is being dictated by the words of one man, which is Jerome Powell. So this economic calendar becomes very important to take note of, and I want you all to screenshot on your phones right now. Take a screenshot. I know most of you watch on mobile, and screenshot this calendar and make sure to keep up to date, because these are the dates where we will experience volatility, and these are the dates that are going to make a massive difference in the US market. The other thing that I think are going to have a massive impact, and this is actually what causes many stock market crashes, are earnings announcements. And we know Q4, we are going to start seeing these earning announcements come to fruition from the big companies. We recently saw that Apple actually is contracting, or has rumors of contracting its production down 10% from the previous quarter, meaning they know there's not as many demand for iPhones. So Apple, being one of the biggest manufacturers in the world, they're actually manufacturing less because of a precedented drop in demand. Now, this is quite weird because Apple has never really does this. In fact, every year they're trying to increase production to keep up with demand. We're now seeing discretionary income come under scrutiny, and now disposable income starting to decrease a little bit, is starting to hit the bottom line of these major companies. So I do think if Apple ends up selling less iPhones, this trend is not just exclusive to Apple. I'm using Apple as a proxy to explain the broader market, because many other companies which are in a worse financial position and have worse products, they are probably going to struggle as well. So I do see Q4 earnings as being a very volatile time in the market, and that could very well be a catalyst for the stock market drawdown that we are talking about that could occur, because we are kind of a ways to go away from that drawdown. We've had many CEOs step down in recent times as well. It seems very all doom and gloom. But here is the positive side of things, and here is where things do get a little bit more positive, because I don't want to be all doom and gloom, because this macro environment is, at the end of the day, temporary if we take a long-term time horizon. Bitcoin volumes right now are doing something very interesting. They are actually increasing against the GBP, which is the Great British Pound. This means people holding the Great British Pound are trading pounds for Bitcoin with the most volume that we've seen in years. What this indicates is that people with a weakening currency after the Great British Pound has collapsed versus the US dollar, they're opting to go for a form of harder money, a form of sounder money in the form of Bitcoin. Now, what this does is it indicates to me a long-term trend. And although I don't think this will continue, I think that it gives us a little bit of a window into the future that if currencies are really struggling against the US dollar with the US rate hikes, can Bitcoin long-term be a viable solution to currency devaluation and debasement? And I think yes. I think Bitcoin is a store of value. It kind of makes sense, but Bitcoin as an inflation hedge, or at least a hedge against a decline in your local currency, that is one of Bitcoin's biggest use cases. And I do think what we may see in the future is struggling countries, and I'm not saying the UK is struggling necessarily compared to some of these other developing countries, but struggling nations may consider trading out some of their local currency for hard money in the form of hard assets like Bitcoin, because it's sound money, and long term, that's definitely a narrative that can drive Bitcoin forward. So although it's doom and gloom in the short term, in the long run, Bitcoin, if it can kind of decouple from equities and go away from being a risk asset to being a form of sound money, that could completely revolutionize the crypto industry, and that could cause a massive rally in Bitcoin. And I do think this is where the space is headed long term. The problem is in the short term, if the stock market does have a major downturn like we think it can, then obviously Bitcoin's going to get hit. It's still a risk asset. So although that thesis may play out of people trading currency and nations trading currency to adopt Bitcoin as a form of currency or a store of value, this may take a long time to play out, and I think it will. And when that rally occurs, which I'm sure one day it'll occur, that's going to be a glorious thing for crypto. And obviously, with the altcoins following the Bitcoin price, we will see an increase in altcoins, or we should see an increase in many altcoin prices, as people tend to take profits from Bitcoin into the alts, as people kind of they get a little bit greedy, and markets tend to go more risk on. But that will only happen when the macro environment sorts itself out. So although the sheer amount of wealth destruction has been ridiculous, long-term Bitcoin may be the solution for many nations. And that's certainly something that I'm starting to realize now during this massive crisis that we're currently experiencing. But when people trade out of altcoins, they're going to need infrastructure to do so. So I think the altcoin projects with the best infrastructure, so the payments networks, the best AMMs, the best liquidity providers, DEXs, those and the bridges, the ones that are really underpinning the crypto ecosystem, those are the assets that are going to perform. One form of this is wallets. Wallets are definitely something that's needed in order to store, buy, swap crypto. And we've seen wallet users grow significantly in recent times. So I think that could definitely be a narrative that plays out. And that kind of reminds me of my sponsor today, which is BlockWallet. They have a good wallet, which in my opinion is actually better than MetaMask. It's just got better UI in my opinion, and it's just very, very smooth to use. You can see a graphic of it here. That is actually a wallet where you can do swaps like I'm talking about, because people are going to need a place to swap. So I do recommend checking out BlockWallet for personal usage, but they also have a token, and I'm not sponsored to shield the token at all. I'm sponsored by BlockWallet to share the product, which I think is really, really good. But tokens like BlockWallet, in a similar vein, the ones that have good connections to kind of the infrastructure narrative with the wallets, etc., they could perform. Now, this is a very long-term niche, but it's definitely something to keep your eye on. And nonetheless, irrespective of that narrative, I definitely recommend trying out BlockWallet. There's a link in the description to do so. And I want to thank them also for sponsoring the show. And I genuinely, I'm being 100% honest right now, have mostly switched out my MetaMask usage for BlockWallet, as it's been a good experience, because I tested out the project one day, and then I actually realized, well, this UI is actually pretty good. And then I made the switch over with BlockWallet as well. Good way to diversify assets throughout multiple wallets. So just to summarize, I know it's kind of scary with this stock market drawdown. It probably does allude to new lows. In the short term, though, in October's historically been a positive month with an average of 22% increase for the Bitcoin price. October also is leading into midterms on November 5th. And it's unlikely, in my opinion, that the Democrats would want to crash the market before midterm elections. So that is kind of one little bit of hope that the new lows don't come in October. But I do expect the stock market to respond negatively at some point in the near future. And when it does, that is probably when Bitcoin bottoms, whether that's in Q1 next year or maybe even November, December this year, or slightly later than that. I can't tell you because I don't have a crystal ball. I'm just telling you in general what to expect. So if you enjoyed the video, make sure you smash the like button, click the subscribe button. Hope you enjoyed this video, and I will see you again on the channel very, very soon. Peace out, guys.